Imagine you design a computer chip.
Right.
Like something so incredibly complex, so densely packed with billions of microscopic transistors that a team of, brilliant human engineers would need 5 full weeks just to verify that it won't physically melt the moment you plug it into a server.
Oh, yeah. 5 weeks of just painstaking, tedious simulation.
Exactly. Yeah. Imagine handing that exact same digital blueprint to an artificial intelligence. You give it a high-level goal, and you watch it finish the entire verification process before you've even finished your morning coffee.
Right. Going from 5 weeks of human labor to less than a single day of autonomous compute. It's wild.
It is. And today we are pointing our lens squarely at the company making that science fiction scenario an absolute operational reality. So welcome to the Stock Tickers Deep Dive. Today, we're breaking down the Q2 2026 earnings call for Cadence Design Systems.
Yeah.
And for those of you checking your brokerage apps right now, that is ticker symbol CD-DNS.
And our mission for this deep dive is highly specific. We are taking the dense, highly technical Wall Street jargon from this hour-long earnings call and translating it into plain language, actionable insights for you.
Because, let's be real.
Right. Cadence is arguably the most critical quiet engine behind the world's advanced semiconductors. If a tech titan is designing a next-generation AI processor, they're utilizing Cadence's electronic design automation software to build it. Period.
Yeah, they literally cannot build it without.
Exactly. The stakes here are profound because Cadence's performance is effectively a leading indicator for the entire global technology hardware sector.
Well, I want to set the tone right out of the gate here by looking at a statement from this call that should make any investor sit up.
Oh, Anirudh's quote.
Yes, Cadence's CEO, Anirudh Devgan, he told analysts that this quarter represented the, quote, highest raise we ever had for annual revenue guidance in a single quarter.
Which is just a massive flex.
Right. For a mature, deeply entrenched enterprise software company to hike their full year forecast by that magnitude mid-year, it's astonishing.
Truly.
But, as we comb through these documents, the ultimate question we have to answer for you today is whether this is just another layer of AI hype or if there is real, cold, hard cash validating these claims.
And to answer that, we have to start with the top line numbers because they completely shattered consensus estimates.
Oh, totally.
So for the second quarter of 2026, Cadence delivered total revenue of $1.584 billion.
Wow.
That translates to a 24% year-over-year growth rate. And look, we really need to pause and contextualize that figure.
Yeah, let's break that down.
Because if you're looking at an early stage startup, a 24% growth rate is, just an average Tuesday.
Right.
But for a company operating at a multi-billion-dollar annualized run rate, a company that has been a foundational cornerstone of the semiconductor ecosystem for over 30 years, expanding the top line by nearly a quarter in a 12-month period is practically unheard of. It points to a structural shift in their total addressable market.
It's a staggering acceleration.
Yeah.
And looking at the profitability metrics, the picture gets even more interesting. Mm-hmm. Their non-GAAP earnings per share came in at $2.11. But I want to be transparent with the listener here. Their GAAP EPS, like the strictly regulated accounting standard number, was only $1.33.
Right, the gap between the GAAP and non-GAAP.
Yeah, and Wall Street analysts and the management team heavily emphasized the non-GAAP metric in this specific industry. But I always get a bit skeptical when the gap between GAAP and non-GAAP is that wide. It's almost an 80-cent difference.
The big spread.
Like, what are they stripping out to make that non-GAAP number look so appealing?
Well, it's a vital distinction to make, honestly. Mm-hmm. When you look at the reconciliation tables in their press release, the vast majority of that difference comes down to stock-based compensation and the amortization of intangible assets from recent acquisitions.
Okay.
In the software industry, paying engineers with stock is just standard practice. It conserves cash and aligns employee incentives with shareholders.
Right.
But the JAP rules force companies to record that stock as a strict expense. Non-GAAP strips it out to give investors a clearer view of the actual cash-generating operating leverage of the core business.
I see.
So, you can debate the philosophy of stock-based comp all day. But when evaluating pure operational efficiency, that non-GAAP lens shows a highly profitable operating margin of 45.5%.
45.5%. Listen, if you're an investor who spends most of your time looking at traditional consumer electronics companies or like retail hardware, seeing a 45.5% operating margin feels like looking at a misprint.
You really don't.
Like, how does a company retain nearly half of every dollar it brings in as operating profit?
Well, it highlights the pristine beauty of the enterprise software business model. I mean, Cadence spends an absolute fortune on research and development. That is their primary fixed cost. They have to employ some of the most expensive physicists, mathematicians, and computer scientists on the planet to build these tools.
Right, the talent is not cheap.
Not at all. But once that software architecture is built and validated, the cost of replicating it and distributing a new license key to a customer is virtually zero.
Ah, right. Zero marginal cost.
Exactly. Every incremental module activated by a semiconductor client drops almost purely to the bottom line.
Wow.
However, as impressive as the historical Q2 revenue and margins are, the metric that truly dominated the analyst Q&A session is entirely forward-looking.
Yeah, I'm looking at the transcript here, and the analysts were practically foaming at the mouth over the backlog.
Oh, absolutely.
Cadence announced a record-breaking backlog of $8.1 billion. Now, let's break this down mechanically for you listening. What is the actual accounting mechanism behind a backlog? And why does an $8.1 billion figure change the investment thesis?
So, backlog is one of the most crucial concepts for understanding financial predictability in software. Under strict revenue recognition rules, specifically ASC 606, a company cannot claim revenue just because a contract is signed.
Okay.
The backlog represents legally binding, guaranteed future revenue. It consists of contracted orders where the customer has formally committed the funds, but Cadence has not yet delivered the service over the time frame of the contract.
Right.
So imagine a major hyperscaler signs a 3-year, $150 million contract for a suite of Cadence tools.
Okay, a huge deal.
Yeah. That $150 million does not show up in the $1.58 billion Q2 revenue we just discussed. Instead, it gets deposited into the backlog, and it bleeds into recognized revenue gradually, quarter by quarter over those 3 years.
So it essentially functions as a giant financial shock absorber.
Precisely. It fundamentally de-risks the company's future cash flows. To put that $8.1 billion figure into perspective, Cadence generated roughly $1.58 billion in recognized revenue this quarter. That means they currently hold over 5 full quarters worth of revenue already legally locked in, signed, and sitting in the vault.
That is insane.
An $8.1 billion backlog implies a level of frantic, locked-in demand from their customer base that insulates them from macroeconomic volatility.
And the CFO, John Wall, pointed out that this backlog expansion was driven by a surge in Q2 bookings, which were up roughly 55% in the first half of the year compared to the first half of last year.
Mm-hmm.
But wait, here's where I need you to clarify something, because during the Q&A, an analyst from Wells Fargo pointed out that 2026 was historically scheduled to be a, quote, low renewal year for Cadence.
Yeah, that is a phenomenal catch by the analyst, and it reveals the underlying momentum here. Enterprise electronic design automation contracts traditionally run in rigid 3-year cycles.
Okay.
Because of this, software companies experience what we call lumpy booking years. If you signed a massive cohort of clients in 2023, they all come up for renewal in 2026, causing a booking spike.
Right, that makes sense.
But management explicitly guided previously that 2026 was the trough of their specific 3-year cycle. Very few major legacy contracts were scheduled to expire and renew this year.
Okay, wait. If nobody is scheduled to renew their contracts, how on earth did bookings spike by 55%? Like, where is that sudden influx of capital originating?
Mid-cycle expansions.
Really?
Yes, and this is arguably the strongest bullish indicator hidden in the entire earnings transcript. Semiconductor designers who are currently halfway through their existing 3-year contracts are looking at the relentless pace of artificial intelligence development, looking at their own compute resources, and realizing they are hopelessly under-equipped.
Wow. So they're tapping out their resources early.
Exactly. They don't have enough software licenses, they don't have enough hardware emulation capacity, and they are essentially knocking on Cadence's door saying, we cannot wait for our scheduled renewal in 2027. We need to purchase vast amounts of additional capacity today.
So they have an $8.1 billion backlog of locked-in cash driven by just panic buying from customers who already have active contracts.
Yeah.
But what exactly are these companies buying? I mean, numbers on a spreadsheet only tell us the velocity of the business. They don't tell us the mechanism.
Right.
What is driving this sudden insatiable demand? Because management spent a significant portion of the call detailing what they refer to as their AI three-layer cake. So let's dive into the product portfolio.
Let's do it. The broader context here is that every single product group within Cadence reported double-digit year-over-year growth.
Which is rare.
Extremely. This was not a scenario where one trendy new product masked severe degradation in their legacy tools. It was systemic strength across the board.
Yeah.
But the undeniable standout, the absolute rocket ship within the earnings report was their IP business, which grew over 40% year over year.
Over 40% growth just for IP. Now look, when the average retail investor hears the acronym IP, they immediately think of intellectual property in the legal sense, copyrights, patents, lawyers sitting in boardrooms.
Sure.
But in the semiconductor context, Cadence is selling something very different. Let's translate this for the listener. What exactly is a semiconductor IP block?
It is best to think of semiconductor IP as a highly complex, pre-validated physical blueprint for a very specific subcomponent of a microchip.
Okay.
So imagine you are an automotive manufacturer building a revolutionary new electric hypercar.
Right.
You're going to spend all your engineering resources designing the battery chemistry and the aerodynamic chassis because that is your core competitive advantage.
Obviously.
You are not going to waste thousands of engineering hours inventing a new windshield wiper motor from scratch. You simply purchase a pre-designed, heavily tested windshield wiper module from a supplier and integrate it directly into your car.
Oh, I see. So Cadence is essentially selling the pre-engineered windshield wiper motors for custom microchips.
Spot on. They sell pre-designed blocks of circuitry that semiconductor firms can drop directly into their larger custom chip architectures.
Got it.
And right now, the demand for very specific categories of IP is just exploding. Anirudh highlighted two massive growth drivers: interface IP and memory IP. He specifically rattled off a list of standards, citing surging demand for PCIe, UCIe, HBM, and LPDDR6.
Okay, let me stop you there.
Yeah.
Because that is an aggressive alphabet soup of technical jargon.
Fair enough.
If we're going to understand why this division grew by 40%, we need to understand the physics of what these acronyms actually do. Like, why is memory and interface IP suddenly the hottest commodity in Silicon Valley?
Well, to understand the demand, we have to understand the core bottleneck of artificial intelligence, specifically AI inferencing.
Okay.
Inferencing is what happens when you actually ask an AI model a question, like generating a prompt.
Right, like when you type into ChatGPT.
Exactly. The processing units, the GPUs or custom accelerators, are incredibly fast at doing the math. But to do that math, they require a constant, massive tsunami of data to be shuttled back and forth between the processor and the memory banks.
Okay.
This creates a severe traffic jam known in computer science as the von Neumann bottleneck. The processor is literally sitting idle, waiting for the memory to feed it data.
Wow. So the limitation isn't how fast the AI can think, it's how fast it can remember.
Exactly. Well, to put it perfectly, it is how wide the highway is between the brain and the filing cabinet.
I love that analogy.
Right. So HBM, which stands for high bandwidth memory, is the physical solution to that traffic jam. It involves stacking memory chips vertically and placing them incredibly close to the processor.
Okay.
But a custom AI chip doesn't natively know how to talk to an HBM stack. Cadence sells the IP, those microscopic circuitry blueprints that acts as the perfect frictionless translator between the customer's custom chip and the HBM memory.
Oh, wow.
As the global volume of AI inferencing compute begins to dwarf the initial training phase, every single hyperscaler needs these highly specialized memory architectures to keep their servers from choking on data.
Okay, so that explains the memory side, but he also mentioned PCIe and UCIe. What role do those play in the architecture?
If HBM is the highway to the local memory, PCIe, which is Peripheral Component Interconnect Express, is the massive interstate highway connecting different processors across the entire server board.
Got it.
As data centers scale up, data needs to travel between GPUs flawlessly and at the speed of light. Cadence provides the physical layer IP that ensures that signal integrity remains perfect.
And the UCIe.
UCI stands for Universal Chiplet Interconnect Express, and this actually transitions us perfectly into the next massive growth driver management discussed. UCIe is the bridge used when you chop a massive chip into tiny pieces.
Tiny pieces.
Yeah, and Cadence noted that their System Design and Analysis, or SDA segment, grew a phenomenal 37%.
37% growth for SDA. What is the technological shift driving that specific software suite?
It is the death of traditional scaling. For decades, the semiconductor industry relied on Moore's law, the idea that you could just shrink transistors and pack more of them onto a single flat piece of silicon.
Right, smaller and faster.
Exactly. But we are reaching the fundamental atomic limits of physics. You simply cannot make the transistors much smaller without electrons randomly jumping across barriers.
They just leak out.
Right. So since they cannot build wider, the industry has decided to build upward. This is known as advanced packaging, or 3D IC.
So instead of a sprawling one-story ranch house, they are building silicon skyscrapers.
Precisely. They take several smaller, specialized chips, referred to as chiplets, and stack them vertically, bonding them together into a single unified system.
Okay.
But doing this introduces nightmarish physics problems. When you stack active, incredibly powerful processors on top of each other, you trap heat in the middle layers. It acts like a microscopic oven.
Oh, that makes sense.
Yeah, the thermal dynamics can physically warp the silicon. Furthermore, the electrical signals from the top chip can cause electromagnetic interference in the bottom chip.
Wow.
So Cadence's SDA segment provides the multi-physics simulation software required to model these thermal, electrical, and mechanical stresses simultaneously. If you are building a 3D chiplet architecture, you literally cannot physically succeed without simulating the thermal crosstalk first.
It is mind-bending to consider the thermodynamic engineering happening at the microscopic level there. But let's elevate from the hardware physics to the software orchestrating it all.
Sure.
Management dedicated a huge portion of this call to what they branded as Agentic AI, specifically rolling out their new AI SuperAgents with names like AuraStack, TiffStack, VeraStack, and InnoStack.
Right.
They are claiming these agents are delivering up to 15 times higher productivity and cutting time to market in half. So what distinguishes an AI superagent from the standard machine learning tools we have heard about for years?
This is where we need to visualize management's 3-layer cake framework.
Okay, walk me through the cake.
They view the future of chip design in 3 distinct tiers. The foundational bottom layer is raw compute and data the server farms powering the operation.
The hardware.
Exactly. The middle layer consists of Cadence's traditional, physically accurate design tools. This is what Anirudh frequently referred to as the ground truth. These are the deterministic physics engines that calculate exactly how a photon or an electron will behave within a specific silicon lattice.
The immutable laws of physics.
Correct. The middle layer does not guess. It calculates reality. Now, the top layer, the icing on this metaphorical cake, is agentic AI.
Okay.
For decades, human engineers had to manually interact with that middle layer. A human would design a layout, run a simulation, wait for the results, interpret the thermal errors, manually adjust the layout, and then run it all again.
Which takes forever.
Right. An AI superagent is a highly autonomous orchestrator that replaces the human in that loop. You give the superagent a complex, high-level mandate. You tell it, find me a chip layout that minimizes power consumption by 15% while maintaining this specific clock speed.
And it just goes to work autonomously.
Think of it like a master chess computer, like AlphaZero. But instead of playing chess, it is playing the game of chip layout. It autonomously explores thousands of different design variations, moving components around on the board.
Wow.
Crucially, to know if a move is legal, it constantly and recursively queries the middle layer, the physics engine, to validate the thermodynamics and signal integrity.
And the productivity claims are staggering. I saw in the transcript that a customer utilizing their VeraStack agent reduced a standard 5-week verification cycle down to less than a single day on a cutting-edge advanced node design.
Yeah, that's real ROI.
But wait, this raises a massive red flag for me as an investor.
Okay, why?
If I'm looking at this business model, Cadence generates revenue by selling software licenses to human engineering teams, right?
Mostly. Yes.
So if they introduce an AI agent that can do the work of 15 human engineers in a fraction of the time, aren't they actively cannibalizing their own core business? Like, why would a semiconductor firm buy 50 software licenses when they can just buy one super agent to do all the work?
It is the most common and logical fear surrounding enterprise AI integration. Will efficiency destroy the seat-based revenue model?
Right.
But management's response to this dynamic is entirely counterintuitive, and it forms the bedrock of their bullish thesis. Anirudh and the executive team explicitly stated that AI agents actually drive an explosive increase in demand for their underlying core software.
Wait, let me push back on that. How is that mathematically possible? If the AI is doing the work faster, why do they need more underlying software licenses? Prove to me this isn't just corporate spin to hide upcoming license degradation.
It comes down to the definition of a bottleneck. Historically, the limiting factor in chip design has never been the speed of the simulation software itself. The bottleneck has been human stamina. Right. A highly skilled human engineer can realistically explore maybe 20 design variations in a given week. They iterate slowly because they have to manually analyze the data, and frankly, they have to log off and sleep.
Humans need sleep.
Exactly. Their exploration of the total possible design space is incredibly narrow. An AI agent does not sleep, and it does not fatigue. When you deploy an AI agent, it doesn't just run the same 20 simulations faster. It decides to explore 20,000 different design alternatives to find the absolute mathematically perfect layout.
I see where this is going.
Right. To test those 20,000 alternatives, the AI agent must continuously, relentlessly invoke the underlying Cadence physics engines to validate every single microscopic change it makes. The AI agent becomes the ultimate power user of the software.
So it's hammering the system constantly?
Yes. So a semiconductor client deploying these super agents ends up consuming vastly more raw compute power and running vastly more core Cadence simulation tools concurrently than a human team ever could. The AI does not replace the Cadence license. The AI hyperactivates the usage of the middle layer.
Wow. So they monetize the core physics engine through exponential usage, and they sell the agent license as a premium overlay on top of it.
Exactly.
That is a structurally brilliant defensive moat.
Speaking of defensive moats, let's pivot to the strategic business developments, because there was a massive announcement regarding Intel that seemed to dominate the tone of the call.
Oh yeah, the 14A deal.
Management detailed a multi-year, highly strategic collaboration with Intel targeting their 14A process node, which heavily integrates Cadence's IP and Agentic AI. But if Cadence is already the industry standard, why is closing this specific Intel deal considered such a monumental victory? Weren't they already embedded there? They had a presence, but historically, Cadence's relationship with the major semiconductor foundries, the actual fabrication plants that print the chips, has been slightly asymmetrical.
How so?
Over the past decade, Cadence became incredibly dominant and deeply integrated with TSMC, the Taiwan semiconductor manufacturing company. That partnership was historically their strongest pillar. But by the CEO's own admission during this call, they were comparatively weaker in their integrations with Intel and, to a lesser extent, Samsung.
Which, if we are analyzing risk, is a significant vulnerability. If your entire software ecosystem is disproportionately optimized for TSMC, you are heavily exposed to any geographic, supply chain, or geopolitical friction involving Taiwan.
That is the core risk factor. However, with this earnings report, they provided concrete evidence that they have dramatically diversified that foundry base.
Okay.
Anirudh stated that optimizing flows for Intel has been a 10 or 20-year-old problem that they have now definitively solved. They are now deeply embedded in the foundational optimization for Intel's upcoming 14A process node.
And 14A is Intel's attempt to reclaim the unquestioned performance crown. It is their cutting-edge, next-generation manufacturing technology utilizing high-NA EUV lithography. It is basically a bet-the-company node for Intel.
It is. And it wasn't just Intel they highlighted. They also announced heavily expanded collaborations with Samsung for their 2-nanometer gate-all-around and 3D IC technologies, as well as a strategic partnership with Rapidus.
Rapidus?
Yeah, the new state-backed semiconductor consortium in Japan aiming for 2-nanometer production.
So synthesizing all of this for you listening, Cadence has transitioned from being heavily reliant on the TSMC ecosystem to becoming the ubiquitous, universally integrated baseline across every single leading-edge foundry on the planet. Whether a massive tech firm firm decides to print their AI chips at TSMC in Taiwan, Intel in Ohio, Samsung in South Korea, or Rapidus in Japan, Cadence is sitting at the toll booth with tightly integrated factory-specific tools.
It is a masterful geographic and technological de-risking of their revenue streams. They are essentially agnostic to which foundry wins the manufacturing wars because they supply the blueprints for all of them.
All right, the historical data is phenomenal. The product portfolio is perfectly aligned to solve advanced packaging and memory bottlenecks, and they have secured the ultimate diversified foundry mode.
Yep.
But, the market is a forward-looking voting machine, and investors only care about what happens tomorrow. Let's move to the management guidance. This is where we gauge their internal confidence in that $8.1 billion backlog.
And the guidance was aggressive. For the full fiscal year 2026, management raised their revenue forecast to a range of $6.26 billion to $6.34 billion.
Which represents a 19% year-over-year growth rate at the midpoint. Again, 19% annual growth for a legacy software giant is phenomenal.
They also raised the bottom line forecast. Full-year non-GAAP EPS guidance was bumped up to a range of $8.05 to $8.15.
So we have massive top-line growth, a historic backlog, and raised annual guidance across all key metrics.
Yep, hitting on all cylinders.
But our job here is to find the friction in the transcript. And there was a very distinct catch buried in the forward guidance, specifically concerning the third quarter.
Right, the margin dip.
While the full year numbers look flawless, John Wall, the CFO, noted that Q3 operating margins are actually projected to contract slightly. They are guiding for Q3 non-GAAP operating margins of 43.5% to 44.5%. That is down from the 45.5% they just achieved. Now, if you are a retail investor analyzing an enterprise tech company, a sudden margin contraction usually sets off alarm bells. Like, are their internal costs spiraling? Are they losing pricing power?
It is a vital discrepancy to analyze, and several analysts on the call, notably Ruben Roy from Stifel and Gianmarco Conti from Deutsche Bank, they relentlessly pressed the executive team on this exact point.
I would too.
They wanted to know why research and development expenses were suddenly accelerating enough to compress the margin profile.
Look, I'm going to push back on management here. Every time a tech CEO reports a margin dip, they claim it is a, quote, strategic, deliberate investment cycle.
Always.
How do we know this isn't just bloat? How do we know they aren't just overpaying to retain AI engineers in a tight labor market? Show me the evidence that this capital is being deployed efficiently and not just vaporized.
Well, the CFO's defense was remarkably specific, which provides some comfort against the bloat argument. He outlined that this is a highly targeted deployment of capital aimed at capitalizing on the specific structural wins they just secured.
Okay.
They are directing funds into two distinct avenues in the second half of the year. First, they are absorbing the integration costs of the Hexagon D&E business.
Right.
This was a recent strategic acquisition specifically designed to bolster that fast-growing system design and analysis segment we discussed earlier.
And acquisitions are notoriously messy to integrate. You have to migrate IT systems, align overlapping sales territories, cross-train massive tons of application engineers that burns cash up front.
It does, but the second and arguably more important driver of the R&D spend is the Intel collaboration. When you sign a multi-year, multi-domain foundational partnership with a behemoth like Intel, targeting their most advanced 14A node, you cannot just hand them a software disk and walk away.
Right. You can't just email them a download link.
Exactly. You have to aggressively hire and deploy highly specialized application engineers and R&D resources to co-optimize the software with Intel's physical manufacturing processes.
The CFO framed it as explicitly setting aside $20 to $25 million specifically for these targeted investments in the second half of the year, with the explicit goal of setting up structural margin expansion in 2027.
Yes.
Essentially, he is arguing that this short-term margin compression is a mandatory down payment to secure a decade of high-margin Intel revenue.
Precisely. If you are a long-time investor, you actually want a management team that possesses the discipline to take a temporary 1 or 2% hit to their quarterly margin to properly fund a 10-year structural moat.
That makes sense.
Refusing to invest in the Intel integration just to make the Q3 spreadsheet look marginally better would be a catastrophic strategic error.
And frankly, they have the liquidity to fund whatever they want. The transcript shows they are projecting roughly $2 billion in operating cash flow for the year.
Massive cash generation.
That is $2 billion in raw cash being organically generated by the operations. And what they are choosing to do with that cash is perhaps the most definitive signal in the entire earnings report.
Oh, the buybacks.
Yes. Management reiterated their commitment to allocate 50% of their free cash flow directly to share repurchases.
Capital allocation frameworks are the purest window into a management team's psychology.
Let's deeply unpack the mechanics of share buybacks, because it is often misunderstood. When a company utilizes half of its free cash flow to purchase its own stock on the open market and subsequently retires those shares, it permanently reduces the total number of shares outstanding.
Right.
Therefore, every remaining share, the ones held in the portfolios of you listeners, suddenly represents a mathematically larger percentage of ownership in the underlying business. It artificially inflates the earnings per share simply because the exact same pool of net income is now being divided by a smaller denominator of shares.
That is the mechanical reality. But the psychological signaling is far more profound. A management team has a menu of options for their free cash flow. They can hoard it in treasuries, they can pay a massive dividend, they can attempt risky acquisitions, or they can launch expensive marketing blitzes.
Sure.
When executives look at that entire menu and conclude that the single highest return on investment available in the global market is purchasing their own stock, they are broadcasting a very clear message. The market is fundamentally mispricing our future cash flows.
They are backing their rhetoric with billions of dollars. If Anirudh and John Wall truly comprehend the stickiness of the $8.1 billion backlog, if they see the internal telemetry on the explosive compute usage of their AI superagents, and if they know the long-term value of the finalized Intel integration, the most rational fiduciary action they can take is to vacuum up as much Cadence equity as possible before the broader market fully understands the compounding nature of these catalysts.
Exactly.
Dedicating 50% of free cash flow to buybacks while simultaneously investing heavily in R&D is an incredibly aggressive posture of supreme confidence.
It perfectly synthesizes everything we have discussed. The balance sheet is a fortress, and they are deploying it offensively.
We have dissected the historical data, we have explored the physics behind the AI three-layer cake, we mapped out the foundry de-risking, and we challenged the margin guidance. So where does this leave the retail investor attempting to make sense of this sector?
Well, when you aggregate the fundamental data points, a 24% revenue expansion for a legacy software provider, a 5-quarter, $8.1 billion locked backlog, a 55% surge in first-half bookings during what was explicitly modeled as a low renewal trough year, and the most geographically diverse foundry integrations in the company's history, the aggregate signal is undeniably bullish.
My interpretation aligns with that bullish assessment. Now, translating this into a framework for you listening. If you're currently building or holding a bullish thesis on Cadence, this earnings transcript serves as profound fundamental validation.
Absolutely.
The critical takeaway is that Cadence is not participating in the speculative phase of AI. They're actively currently monetizing it. The 40% explosion in their IP business, driven by the immediate physical requirements of high bandwidth memory architectures, proves that AI-driven revenue is hitting their income statement today, not in some hypothetical future roadmap.
Furthermore, for those evaluating the tactical landscape of the stock, the transparency regarding the Q3 guidance is crucial because management explicitly telegraphed the upcoming slight margin contraction driven by the Hexagon and Intel integration investments. They have set a trap for short-term algorithmic trading.
A trap?
Yeah. If the stock experiences a temporary pullback in the coming months purely because a headline algorithm flags a Q3 margin of 43.5% instead of 45%, that is exactly the kind of short-term, context-blind noise that value-oriented, long-term investors historically utilize to their advantage.
The structural setup for 2027, fortified by the continuous pressure of 50% free cash flow buybacks and the immense visibility of the backlog, paints a picture of a company operating at the absolute peak of its leverage.
They are essentially taxing the architectural complexity of the most significant technological infrastructure build-out in modern economic history.
Well said. Before we conclude this deep dive, though, I want to leave you with one final, deeply provocative thought to analyze on your own. It is something that did not make the headline financial summaries, but it emerged during a fascinating philosophical exchange late in the Q&A session. An analyst named Joe Verink from Baird asked a question that strikes the core existential fear surrounding artificial intelligence software.
Ah, the open source question.
Yes, he brought up the rapid advancement of open source AI models, specifically citing a model internally referred to as Kimi. His question was essentially this: what happens if an open-source large language model becomes so extraordinarily advanced that it can autonomously generate a complete chip layout from end to end? Does it eventually bypass commercial electronic design automation tools entirely? In a decade, does the superintelligent AI simply render Cadence obsolete?
It is the ultimate existential threat for any software company operating today. Will the artificial intelligence eventually write the software, execute the software, and entirely replace the human need for the software?
Exactly. But the defense articulated by management was technologically brilliant. And Arud argued that even the most advanced, radically capable neural networks fundamentally require a ground truth.
Right.
A sophisticated language model can hallucinate an incredibly elegant, highly optimized chip layout in code. But an algorithmic language model does not inherently understand the unforgiving physical laws of thermodynamics.
Nope.
It does not natively comprehend how an electrical current will arc across a 2-nanometer gap, or how parasitic capacitance will degrade a signal at high frequencies. To validate that the hallucinated AI-generated chip will not instantly burst into flames when plugged into a server, the AI is absolutely forced to check its work against physically accurate, deterministic physics engines.
Which circles us back to the middle layer of the cake, the ground truth. The laws of physics cannot be bypassed by an elegant line of code. As AI agents become more capable at orchestrating the design process, they will inevitably generate millions of more complex designs, all of which absolutely must be validated by Cadence's physical simulators to prove they can exist in the thermodynamic reality of our universe.
Will artificial intelligence eventually eliminate the need for Cadence? Management fiercely argues the exact opposite. In their architectural view, the AI will not replace Cadence. The AI will simply become Cadence's largest, most demanding, and highest consuming customer.
It is a phenomenal dynamic to monitor as open source models continue to scale.
It really is. When the technological gold rush becomes chaotic, and the prospectors invent increasingly bizarre and advanced methods to locate the gold, you do not panic. You simply ensure that regardless of the method they invent, they are still fundamentally required to purchase your simulation tools to break the physical dirt.
Well put.
Thank you for joining us for this extensive Talk Tickers deep dive into Cadence Design Systems. We hope we translated the noise into actionable signal for you today. Remember to scrutinize the fundamentals, stay rationally focused on the long-term mechanics, and keep watching the tickers.